Hello, this is Rick Ackerman, editor and publisher of Rick's Picks with an update. I'm going to take a somewhat longer, maybe intermediate term perspective. I love to short the market, same as you would, and in part because you can see that the world is sliding into recession. Europe is already there. There has been a considerable slowdown in Chinese output. We're starting to see the U.S. economy itself break down, notwithstanding a flurry in new home sales that's been triggered by some of the lowest mortgage rates that we've seen in generations. I think that's partly to explain the buoyancy in U.S. stocks, but as the chart that I'm showing you here makes clear, copper, which is a very good economic indicator, has lower to go, currently trading at around $2.57 a pound basis the December contract, and it has a very clear target down there at $2 and let's call it 20 cents. Let me also mention that if and when it gets down there, it's going to be an excellent place to bottom fish because of the clarity of this pattern. I would say that you can do it with a tight stop loss of perhaps a couple of pennies. All right, so anyway, copper is reaffirming a picture of a slowing economy, and I think there's probably a chance that the U.S. economy is already in recession. A couple reasons, though, why I'm not laying in an inventory of put options. I did explain one of them earlier. Apple shares, let's take a look here, are currently trading around 220, but I'm very confident that the 242 target shown in this chart is going to be reached. And of course, as long as a key bellwether like Apple is not has more upside ahead of it, the stock market itself is going to remain at the very least buoyant, even if it doesn't track the steep move that seems to lie ahead for Apple. One other chart that I want to show you is the, well, let's see if it's hiding here. A stochastic. Now, one of the ways that we use stochastics to get a handle on the big market moves, if not perfect timing indicators, has to do with these peaks here up in what you would call the overbought zone. And you can see that we have declining peaks in instances where we had a pretty good sell-off. Here, the industrial average got pretty overbought at this high, and when the price peak went even higher, the indus were not able to get quite as overbought. So that's what you call a bearish divergence, and it foretold the steepness of this correction that occurred back in April and May. But notice how the last two peaks on the weekly chart in the industrial average have been accompanied by essentially diminishing stochastic peaks, and this is what you call non-diverging, and it's usually an indication that the trend will continue. So even though we could get a sell-off of some sort in the indus, the regularity of the stochastic peaks, the fact that they're not declining relative to the price peaks, suggests that the uptrend, the long-term uptrend, will continue. So that's about it for today, and we'll get together perhaps early next week. I'm doing these presentations on a regular basis on Tuesdays and Thursdays, so stay tuned. Let me also mention that if you want to get more information on this hidden pivot method that I use to forecast and trade, go to rickackerman.com, and up at the top of the page, just simply fill in your name, address, email address, click Start My Free Subscription, and you'll be there. No credit card necessary is to take this free 2-week trial to Rick's Picks. So again, that's it. Thanks very much for joining me, and you'll all have a pleasant good day.